Hi, myself Mahesh Machi. My roll number is MB2205. Subject of my presentation is derivatives and risk management. And topic of presentation is derivatives and portfolio management. Let's start with definitions. Derivatives are financial instruments whose value is derived from the value of an underlying asset, index, a rate, or other financial benchmarks. These instruments are used for various purposes, including hedging against risk and speculating on price movements and achieving portfolio diversification. Common types of derivatives include future contracts of options, swaps, and forward. Future contracts. These are agreements to buy or sell an asset at a predetermined price on a specific future date. Futures contracts are commonly used to hedge against price fluctuation. Options. Options give the holder the right, but not the obligation to buy call options or a sell option, put option, an asset at a predetermined price within a specified period. Options are often used for hedging and speculative purposes. Definition. Swaps. Swaps involves the exchange of cash flows or other financial instruments between parties. Common types includes interest rate swaps and currency swaps. Derivatives play a crucial role in risk management and can be complex instruments. They are traded on organized exchanges or over the counter market (OTC). Portfolio management. Portfolio management refers to the process of managing a collection of financial assets known as a portfolio to achieve specific investment objectives. The primary goals of portfolio management includes maximizing returns, minimizing risk, and achieving a balance between various assets to meet the investor's financial goal. Portfolio management involves a combination of analysis, decision making, and ongoing monitoring. Derivatives. Derivatives are financial instruments whose values is derived from an underlying assets index rate or a benchmark. They derive their value from the performance of an underlying entity, and their value changes as the underlying asset value changes. Derivatives can be used for various purposes, including risk management. Derivatives allows individuals and institutions to hedge against price fluctuation, interest rate changes, or other financial risks. For example, a company might use future contracts to lock in a specific price for a commodities it needs. Speculation. Traders and investors use derivatives to speculate on the future price movements of assets. For instance, buying call options on a stock allows the holder to benefit from potential price increases without owning the stock outright. Enhancing returns. Derivatives can be employed to leverage investments, potentially amplifying returns. However, this also increases the associated risk. Common types of derivatives include future contracts, options, swaps, and forwards. They are traded on organized exchange or over the counter markets. Portfolio management. Portfolio management involves the strategic management of collection of financial assets of portfolio with the aim of achieving specific investment objectives. Key components of the portfolio management include asset allocation, determining the optimal mix of a different asset classes such as stock, bonds, and cash based on the investor's risk tolerance, investment goals, and the time horizon. Securities selection, choosing specific investment within each asset class. These involves analyzing individual stock bonds or other securities to build a diversified portfolio. Risk management, assessing and managing the risk associated with the portfolio. Diversification, the use of derivatives for hedging and other risk mitigation strategies are implemented to achieve a balance between risk and return. Performance monitoring, regularly reviewing and adjusting the portfolio to ensure it aligns with the investor's objectives. Rebalancing may be necessary to maintain the desired asset allocation, return optimization, striving to achieve the highest possible return given the investor's risk tolerance. This involves making informed investment decisions based on market analysis, economic condition, and the investor's financial goal. Performance monitoring, regularly reviewing and adjusting the portfolio to ensure it aligns with the investor's objectives. Rebalancing may be necessary to maintain the desired asset allocation, return optimization, striving to achieve the highest possible return given the investor's risk tolerance. This involves making informed investment decisions based on market analysis, economic condition, and the investor's financial goals. Portfolio management is essential for both individual investors and institutional investors such as mutual funds and pension funds. It requires ongoing monitoring, analysis, and sometimes adjustments to ensure the portfolio remains aligned with the investor's financial objectives in a dynamic market environment. Uses of the derivatives and portfolio. Hedging in corporate finance, where companies use derivatives to hedging against various risks such as commodity price fluctuations, interest rate changes, and currency exchange rate movements. Derivatives are employed when companies want to mitigate the impact of uncertain future market conditions on their financial performance. Investment trading. Traders and investors use derivatives in financial markets to speculate on a price movements, manage risk, and enhance returns. Derivatives are used continuously in financial markets as a traders seek opportunities to profit from market movements, and manage the risk exposure. Risk management in financial institutions. Banks and financial institutions use derivatives to manage various financial risks, including interest rate risk and credit risk. Derivatives are employed as part of ongoing risk management practices, especially in response to changing market conditions. Portfolio diversification, where institutional investors such as the pension funds and endowment use derivatives to diversify their portfolios and manage risk. Derivatives are integrated into portfolio strategies to enhance risk-adjusted returns and provide additional avenues for investment. Portfolio management, individual investment planning, where individuals use portfolio management principles to plan and manage their personal investments. It is applied when individuals are making investment decisions, settling financial goals, and managing their investment portfolios over time. Mutual fund and assessment. Professional funds managers and asset management firms use portfolio management techniques to manage mutual funds and institutional portfolio. It is an ongoing process with managers are regularly making decisions on asset allocation, security selection, and risk management. Pension. Pension funds utilize portfolio management to ensure the long-term sustainability of their investment and meet the financial needs of financial beneficiaries. Portfolio management is a integral part of the ongoing operation of pension funds with adjustment made based on market condition and fund objectives. Wealth management. Wealth management firms and financial advisors use portfolio management to create diversified investment portfolio for high net worth individuals. Portfolio management is used when developing insurance strategies, selecting specific securities, and providing ongoing financial advice. Let's see some advantages of derivatives. Risk mitigation. Derivatives provide a minimum means for a business and investor to hedge against various risks, such as price fluctuation, interest rate changes, and currency exchange rate movement. This helps in reduce the impact of market uncertainties on financial performance, enhance market efficiency. Derivatives contribute to market efficiency by facilitating price discovery and providing liquidity. They allow participants to express their views on the future direction of markets and adjust the positions accordingly. Leverage for return. Derivatives can be used to amplify returns through leverage. This allows investors to gain exposure to larger position size with a smaller initial investment. However, it's important to note that leverage also increases risk. Portfolio management. Advantages of portfolio management. Risk diversification. Portfolio management allows investors to diversify their investment across different asset classes, industries, and geographic regions. These diversification helps reduce the impact of poor performance assets on the overall portfolio, optimize risk return profile. Through careful asset allocation and diversification, portfolio management aims to optimize the risk return profile of an investment portfolio. This involves seeking a balance between potential returns and acceptable level of risk. There are some limitations of derivatives, complexity and risk. Derivatives can be complex financial instruments and improper understanding of users can lead to significant financial risk. The use of leverage is particularly can magnifies losses as well as gains, market volatility. Derivatives market can be highly volatile. Sudden and unexpected market movements can result in substantial losses for derivative traders and investors. Portfolio limitation of portfolio management, market uncertainty. Portfolio management relies on assumptions about future market conditions and asset performance. Unpredictable events such as economic downturn or geopolitical crisis can challenge these assumptions. Diversification and limitation. While diversification is the key principle of portfolio management, it may not provide full protection during extreme market events when correlations among different assets tend to increase. Interest rate risk. Portfolio, especially those with a fixed income or securities and are exposed to interest rate risk. Changes in interest rates can impact the value of bonds and affect overall portfolio performance. Inflation rate risk. Portfolio management may not fully protect against the inflation risk. Inflation erodes the purchasing power of money, and portfolio may need to be actively managed to hedge against the risk. Management fees. Portfolio management services often come with management fees. While these fees provide compensation for professional expertise, they can reduce overall returns, especially in low return environments. Here you can see in this picture four types of derivative contracts and portfolio management service. That's all for my presentation. Thank you. Thank you, sir.